Risk is an integral part of investing, but most investors don't properly understand it or give it sufficient attention. Our guest on this episode is a well-known professional investor who admits that in the past, even he didn't think carefully enough about the risk he was taking. Victor Hagani was one of the founding partners of Long-Term Capital Management. LTCM was a hedge fund founded in 1994, which used quantitative strategies to exploit pricing inefficiencies in global markets, relying heavily on leverage. Initially, LTCM was a huge success, but then it spectacularly collapsed.
We had these terrific returns for 4 or 5 years, and then in 1998, we lost 90% of the fund's value. And most of the fund at that time was comprised of the partners, our own investments.
The fallout from the collapse of LTCM required a $3.6 billion bailout orchestrated by the Federal Reserve. It taught Hagani painful lessons about the excessive risk he'd been taking, and he eventually became a vocal advocate for long-term, low-cost, passive investing. Hagani favors index funds not just because they're very much cheaper than actively managed funds, but because they also provide higher risk-adjusted returns.
The risk-adjusted return on the average dollar will be lower than the risk-adjusted return of the market portfolio. And this is inescapable.
Today, Hagani is a financial author and educator and chief investment officer at Elm Partners, an evidence-based investment management firm. He'll be telling us that actively picking stocks or other financial assets is so competitive that ordinary investors who try it are effectively gambling.
Stock picking is perhaps the most competitive activity on the planet. It's probably more competitive than professional golf.
More than anything, he says, investors need to understand risk better and take it more seriously.
Really think about the return and the risk, because we're not just trying to maximize how much money we have, we're trying to maximize how much money we have minus the cost of risk.
This episode includes useful takeaways for investors everywhere, no matter how experienced or otherwise they are. So enjoy and learn from my interview with Victor Hagani. Victor, perhaps you could start by explaining this relationship between risk and returns in investing. How exactly does it work?
Well, in general, if we want to get more return, we have to take more risk. But there are different kinds of risk that we can take. There are some risks which we can diversify away by holding many different things that are uncorrelated with each other. So, one coin comes up heads, the next flip comes up tails. There's sort of this diversification that you're getting. So there's a part of each stock's risk, which we call it idiosyncratic risk. It's that part of the risk that really pertains to that company and its specific business. And across many different companies, we can diversify away a lot of the idiosyncratic risk. But we can't diversify away what we call the market risk or the systematic risk. And that's the risk of, for instance, the whole economy going down the tubes, or interest rates being much higher, or any kind of more macro type of event that runs through all kinds of different businesses. So that's the risk that we're taking that we need to get compensated for because it's unavoidable, that somebody has to own it in the end. And so given that we human beings are naturally risk averse, and we can talk about why we're naturally risk averse in a moment, that because we're naturally risk averse, we need to get compensation for bearing risks that we can't diversify away.
Now, this whole episode is going to focus on risk, but I don't want to scare investors at the outset, put people off investing, because it is properly managed. Risk is actually a positive thing, particularly if you have a very long-term view, as investors should do. it really shouldn't be such a scary thing. When we talk about it, it's often actually volatility that we're talking about.
Yes, I hear what you're saying, Robin, and I think that bearing risk that is undiversifiable, the systematic risk in our economy, in our companies, in our financial system, that by bearing that risk, we get an expected return. It's kind of like somebody's coming and saying, would you like to flip this coin? I've programmed it or biased it so that it comes up 60% of the time it comes up heads. Well, if I flip that coin, I'm taking a risk. There's still a 40% chance it comes up tails, but I definitely like the opportunity to bet some of my wealth on this biased coin. So I'm taking risk. It might come up tails, but I'm getting a compensation for it. And if you take away my opportunity to invest in risky assets that are giving me a positive expected return, I'm worse off. You would have to compensate me for taking away my opportunity to invest in equities. We're all better off by being able to allocate some of our savings, some of our wealth to investing in stocks, which have this positive long-term expected return, even though they are fundamentally risky, you know, that they can go down and stay down. But we're better off by being able to invest in this positive expected value situation, definitely.
Now, you've written this book. It's called The Missing Billionaires, A Guide to Better Financial Decisions. It's co-authored with your business partner, James White. Perhaps you should start, first of all, by explaining the title of the book.
Sure. So, we titled it The Missing Billionaires because the jumping off point of the book is talking about how wealthy families in the past have been unable, in a shockingly consistent way, to maintain their relative wealth. That if we go back, we have census data in the US, and if we go back to 1900, there were lots of wealthy families in the US in 1900. And all they had to do was to grow their wealth more or less in line with the stock market, even taking account of taxes and with some assumptions about having children and new generations at a normal rate. And if that had happened, we think there would be tens of thousands of billionaire families in America today that would trace their wealth and trace their family fortune back to the early 20th century. And when you look at, for instance, the Fortune or Forbes rich list in America, there's not one, forget about, tens of thousands, there's not one family on there that you can trace it right back. I mean, we did have David Rockefeller, who died recently, but so he was one exception, and maybe there was a few exceptions, but we should have thousands of families that trace back to that. And in the course of talking to people about the book, I've met many people who say, my great-grandfather had this stockbroking firm, and they were so, he was so wealthy, and they bought all this land outside of Philadelphia, but something happened and it never made it to us. And actually, last night with my family, we went to see the Lehman trilogy, right? And here were these three brothers, started off down in Alabama, they went from Bavaria to Alabama, and just imagine at the beginning of the 20th century, this family had millions and millions of dollars of wealth. It was one of the preeminent financial families in New York. By that time, they had moved to New York, and they were just incredibly wealthy. They were at the center of all the action that was going on in finance at the time, making millions of dollars, in single trades or underwritings that they would do. They could make $1 million back then. And yet today, there's no Lehman, there's nobody that we know of from that dynasty, from that family today that's a billionaire. It's incredible given how wealthy they were back then.
You're right, it is extraordinary. So what's going wrong? Are people investing in risky things? Are they simply just spending too much?
So there's lots of factors that can, for any given family, it could be down to lots of things. They could have lots of children, or they could, or they could be inveterate gamblers or whatever. But we think that the main cause of this is not that the investment environment was a poor one where they lost money on their investments, but rather that in many cases that they took too much risk. There's also cases where they didn't take enough risk. But let me talk about a case where maybe you are taking too much risk. So imagine you're one of these wealthy families, and maybe you're a Vanderbilt. You're a descendant of the Vanderbilts, and you're in the early 1900s, and maybe you've got $100 million at that time. I know that sounds crazy, but actually when Cornelius Vanderbilt died, he left $100 million to his eldest son. And that actually grew for a while before eventually dissipating. But imagine that you're, that you have $100 million and it's the early 1900s, and you're one of these descendants of Cornelius Vanderbilt, and you're trying to figure out how much you can spend. You want to buy a piece of land in New York City. You want to put up a nice house with lots of rooms, have lots of help. You also want to maybe have a place up in Newport, Rhode Island. So you talk to your financial advisors, you go talk to JP Morgan and so on, and they say, well, you've got $100 million. I think that we think you could definitely make, let's say you could definitely make 5% a year of expected return on this really nice stock portfolio that we can help you with, which is going to mostly be Vanderbilt equity in transportation stocks or their own company. So we think you can make about 5% a year after inflation. You've made a lot more than that already, but say 5%. So, if you spent around, 3 or 4% of your money each year, you'd be okay because your expected return is 5%. So, maybe you could spend, $3 or $4 million a year on all of your different activities. And you should be fine because we think that you can have a portfolio with a 5% return. The only problem is that this portfolio is going to be pretty concentrated. It's going to be a lot of transportation stocks because you're a transportation family, you're a railroad family and a shipping family. So let's say that the stocks that this stock portfolio that they own is mostly Vanderbilt Enterprises. And the portfolio has a volatility of around 30% a year, which by that, what I mean is, let's say it goes up by 30% and down by 30%, relative to the expected return of 5%. So one year, it goes up 35%. The next year, it goes down 25%. So when up 35, down 25, that's on average 5% each year, right? So now, they go ahead and they start living their life according to that kind of spending. Well, what's happening is that this volatility is directly eating their returns because, let me jump to the punchline, after 25 years, the most likely case of how much wealth this family will have left is zero. Because going up, you imagine that you go up by 135%, that's great, wonderful. You spend, let's just say that, forget about the spending for a second. You go up by 135, you go up by 35 to 135, and then when you go down to 25%, you're winding up not at 110. It's not like you made 5% a year and now you have 110. That this volatility, that losing 25% of the 135 of wealth is much bigger than a loss of just 25, because you're losing 25 also of the 35. So you come down to just 101 of wealth instead of coming to 110. You're at 101. So now you can see that over the 2 years you spent 4% of your money the first year, 4% of the starting money the second year, and you're considerably lower than you were. So the risk, this high risk, is directly eating into the returns that this family can live on. And, you throw a couple of other little twists in there, like the fact that they thought they were going to make 5% above inflation, but inflation turns out that inflation isn't the right metric for them. All of a sudden, they're seeing a cost of living that's going up faster, let's say, than just pure inflation. So they're trying to keep up with the cost of living, so they're spending even more. And it's such a powerful effect, we think, that it's our guess that it really is the main problem that a lot of these families ran into, is that they were spending at too high a rate, and they were taking too much risk in their portfolio, even though the portfolio had a good expected return.
Now, you're very well qualified to talk about a risk yourself. As many financial professionals of a certain age will know, you famously once took a very large amount of risk. It paid off for quite a while, and then it spectacularly didn't, and you lost money that you'd won. Tell us what happened.
So you're referring to me being a partner of LTCM. I was a founding partner of LTCM. That was after I had worked at Salomon Brothers with the same group of people. And we left and started this hedge fund in 1990, at the end of 1993. And that's right, we had these terrific returns for 4 or 5 years. And then in 1998, we lost 90% of the fund's value. And most of the fund at that time was comprised of the partners, our own investments, because after 4 years, we thought that we were having trouble managing such a large pool of capital, and we felt that we should reduce how much capital we were running so that we wouldn't have too big positions and that we could still get a good return. And so we returned a lot of money to our investors rather than returning the money to ourselves. So afterward, the investors were unhappy at the time, but after LTCM went down 90% in 1998, those investors were kind of happy that we had dividended out more than their initial investment even at that time. But from my own personal point of view, I had too much of my family's wealth invested in LTCM. I was an owner of the business. I was a part owner of the business of the management company, and then I had most of my family's savings invested in the fund itself. And I think there are so many great lessons to learn from that. Some of them are so obvious that I don't want to make it sound like these are they're expensive lessons. They're not very complicated ones, but I think that the idea that of investing most of your money in your own business or your own company where you're working, that there's this heightened risk of that because your own human capital is so connected to it. So if you work at a company and they're giving you stock in the company, that's not so good, and you want to sell that stock when you're able to. And I would say to the company, I don't think it's such a good idea to pay people with stock. I was already used to it at LTCM because at Salomon Brothers, they used to pay us mostly with stock as well, in Salomon Brothers, that is. And so you really want to think about all the different ways in which you're invested in your business before you start putting voluntary investments in there, on top of it. And then we always have to remember that financial investments are have this particular kind of riskiness where really bad things do occasionally happen. What we call fat tails. That financial markets and financial returns are not like super well behaved, kind of what they call normal distributions, but they can be a little bit wacky, and really outlier events do happen from time to time. So, I think there's lots of lessons in LTCM, but the basic one is really think about what's the right amount of risk to take, even when you find something that's really attractive. You don't want to bet everything on it. And if you find something that's really attractive, you don't have to bet everything on it to really do well, right? Like if something is good enough and don't be greedy about it is another way of thinking about it, but really think about the return and the risk, because we're not just trying to maximize how much money we have, we're trying to maximize how much money we have minus the cost of risk.
So as you say, it's not a good idea to be heavily concentrated in, just a few stocks or one stock, the company you work for example. That's a particularly bad idea. Something goes wrong, your stock goes down, you lose your job as well, potentially. And then you really are in a mess. You're now an advocate of index funds. And one of the main arguments for using index funds is what the late Jack Bogle, founder of Vanguard, called the cost matters hypothesis. Maybe you could explain briefly, for those who aren't aware of the cost matters hypothesis, what exactly it is.
Sure. So John Bogle, the founder of Vanguard, possibly the person that's done more for the welfare of ordinary investors than anybody else in history, he put forward this idea of the cost matters hypothesis, building on an earlier insight by Bill Sharp, a Nobel economist in financial economics. And the starting point is this really simple but powerful insight, which is that if you take everybody that is not an index investor, if you take everybody's portfolio where they have active stock picking portfolio, so they don't own the market cap weighted index, you take all of these active portfolios, all of these active investors, and you put all of their holdings into a big pot, that pot is going to look exactly like an index fund. It has to, mathematically, all active positions have to sum up to the market portfolio. It's just simple, pure math. Nothing complicated about it. So therefore, we know that the average dollar of all these active investors everywhere, of all the stock pickers everywhere, that the average dollar is going to earn the return of the market portfolio. But it's going to earn that minus whatever fees are associated with all this active investing. So when Bogle came out with this in the early 2000s, or when Bill Sharp actually got the ball rolling on this idea, Bogle kind of rebranded it in a really smart way. Sharp was in the early 90s when he came out with this, that costs were really high. That actively managed mutual funds were, on average, had expense ratios of over 1% a year. If you wanted to trade stocks yourself in your own brokerage account, you were paying, that you could easily pay 1% every time you bought or sold some stock, or more than that. And so the costs mattered a lot. And that insight that, look, you're just going to get the market return minus the cost has driven and drove so much money towards market cap indexing. It's been terrific. And actually, we can sort of test the Bogle hypothesis, the cost matters hypothesis. We can look at the average return on actively managed mutual funds in the US, and we can compare them to the return on index funds. And when we do that, we see that the difference in returns has been about 1%. And so Bogle was kind of right. I mean, and I call this a little bit of a test because, of course, the actively managed mutual funds in the US don't represent all active investors. But if you just draw a circle around those guys, that all of them still come up to look like the market portfolio, which I think is really amazing. That if you get a big enough group of people that are all, running around trying to do something, they kind of average out to the market portfolio. So even though they don't represent all active investors, it's interesting that they do kind of average out to what Bogle and Sharp predicted.
So as you say, there's been some pushback on that Sharp paper from 1991, the arithmetic of active management. But broadly speaking, it's very hard to argue with Sharp and Bogle that investor return is the gross return minus the cost of playing the game. And because indexers pay less to play the game, they, on average, are going to end up better off. So cost matters hypothesis is very important. You would say there's actually something even more important, particularly now, and that's what you call risk matters hypothesis. So what exactly is that?
So starting at the same point as Sharp and Bogle of saying, look, all these active portfolios average out to the market portfolio, and they're going to get the market return. But what we can also say is any way that we partition the market into individual active portfolios, however you do it, we can prove, pretty simple proof, we can prove that the average risk across all of these different active portfolios is higher than the market risk. So let's forget about costs for a minute now. Now we can say that the risk matters hypothesis says that the average investor dollar that's in actively managed portfolios that's doing stock picking, either in a mutual fund or just doing your own stock picking, that the average dollar among all these stock pickers and active mutual funds is going to get the market return minus costs, but let's say costs have now gone to zero. But the average risk of all of those portfolios is higher than the market risk. And so the risk-adjusted return on the average dollar will be lower than the risk-adjusted return of the market portfolio. And this is inescapable. Costs are at zero. This is something that we can't get away from, that the average risk of these partitioned active portfolios, on average, that risk is higher than the market portfolios. On average, everybody's getting a lower risk-adjusted return. And I think that's really powerful. Of course, a lot of people, they think they don't care about risk, but we all have to care about risk. It's kind of inescapable. Some people might say, oh, all I care about is how much money I'm making. But no, you could always make more money. If you can make more money for taking the same amount of risk, you should always want to do that. That's always a rational thing to do. So it's always better to make more money for a given amount of risk, and that risk is a real cost. It's the cost that we bear to make expected return.
And the industry is very clever in the way that it couches this, isn't it? Because, the impression that pundits in the media, fund managers and so on, and the marketing and articles we read in the paper, the impression you get is that active management somehow kind of reduces your risk, particularly on the downside. It offers, we often hear this phrase, don't we, downside protection. But actually, if you're in a more concentrated portfolio, you're in a more risky portfolio.
I think that's right. That what we need to do to help people to make better financial decisions is there's this discussion of ideas like the Bogle cost matters hypothesis. There's also, maybe we should have another hypothesis of the other side matters too. Who's also in your game? Who are you playing your poker against, or who else is in the game with you that's also taking active risk is another important thing. But we just need to have more honest and full disclosure in the financial industry, I think. I think a great analogy for thinking about this is that when you go to Vegas or any casino, you walk into any casino and there's a number of different games that you can play there when you go into the casino. One of them is the slot machines, and you walk over to a slot machine and you can put your money into the slot machine and pull the lever down. And nowhere as far as I know, nowhere in the casino, when you walk in the casino, nowhere on the slot machine does it say that every pound that you put into this machine has a 93 pence payout expected on each pull of it, that you're paying 7 cents each time to pull this thing on average. And yes, you might get a big payoff or you might not, but the odds are that you're paying 7% of the money that you put in there each time. Why doesn't it say that on the slot machine? And this is what we're seeing in the whole financial industry. You go into the underground and there's a big sign there about having a bank account somewhere. But why doesn't it tell you that the money that you put into this bank account is going to basically earn zero for you when you should be getting 3 or 4% or whatever the market rate of interest is? Why doesn't it just stay there in big letters? Why are they allowed to advertise like that? And the answer is, right, it's a kind of regulatory capture that we could spend a lot of time talking about it, but I wish that we could get better disclosure on everything and cut down on regulations that make helping people more expensive and that favor the big incumbents while really doing a great job with disclosure so that people really know what the deal is.
Another impression that the advertising gives us, particularly advertising of these stock trading sites and so on, is that kind of everyone's a winner, and we forget, don't we, that with every trade we make, there is somebody on the other side of that trade who might well have much better information than we do. They might actually work for that company. They may even be operating using illegal inside information. So we've got to think about that invisible opponent on the other side of the net, if you like.
Absolutely, absolutely. It's like generally speaking, that all of us are playing against Roger Federer because and it's like it's kind of a winner take all in a way as well. And it's like it's the most this stock trading, stock picking is perhaps the most competitive activity on the planet. It's probably more competitive than professional golf. Like if you think about how many young people out there try to become professional golfers and how many succeed and make a living from it, I think that ratio could even be a more skewed ratio when it comes to stock picking. There's just a few firms out there that are making hundreds, maybe $100 billion a year on average, these places that we hear about. And there's millions of people that are trying to be the professional golfers of stock picking. So I think the ratio could even be bigger, more against us in stock picking than it is in, say, becoming a professional athlete, in many cases.
Now, you're about to give a guest lecture at your alma mater, the London School of Economics. And I understand one of the things you're going to be talking about is the fact that your mum, at the age of 90, is herself trading stocks. Tell me about that and how you've tried to dissuade her from doing it.
Yeah. So my mom has always been an active, eyes open investor and has done really well over the years with her investments. But about 4 or 5 years ago, her broker told her that she was eligible to open an account with them, like in a separate part of their. She was with a more full service broker, and said, "Well, if you want to do more active trading, I can open this account for you over here in this little subsidiary that we have, and you'll be paying 0 commissions to trade there." And so she got started doing that about 5 years ago, and she's been, markets have generally gone up over that time, and most of her buys and sells have been at a profit because overall the market's been drifting up, with some pretty big, down periods too in there, but overall it's been going up. And she's just become more and more active. I mean, I think she's now doing. She trades probably several thousand trades per year now is her pace. She's doing 10 trades in the morning, 10 trades in the evening, in the afternoon. So she'll put in some trades maybe before the market opens, some limit orders, this or that, and then do some selling in the evening. So she really is a kind of a day trader. Sometimes she'll buy and sell the same thing over the course of the day. Sometimes, but she's working her portfolio, and maybe it's having this wonderful fountain of youth kind of thing for her and keeping her young. But my mom is very active in other things too. She's she was a trained opera singer, and she still really loves classical music and is constantly going to the opera and symphonies and so on, and she's in book clubs. So I don't know at the margin how much this is extra fun for her, but it really got me thinking. I just really viewed it as this challenge to see if I could very politely dissuade my mom and convince her and use her as the sounding board for how these arguments of things like the cost matters hypothesis, who's on the other side, and the risk matters hypothesis, how all of these things would sit with her. But at the end of the day, whenever I would say these things to her, she would say, "Yeah, but Victor, I'm making money. When I stop making money, we can talk about all of this, but I'm making money." But she's not thinking about it in terms of how much money she should be making for the amount of risk that she's taking. And it just seems inescapable to me that on an ex ante basis, that whatever has happened in the past, that the cards are just, the game is terribly stacked against her in terms of making a return that she should get given the risk that she's taking. I think she's going to wind up with a very suboptimal return relative to the risk. And I don't think that any of this individual stock trading makes sense for people. I just don't think that you can come up with true use cases where owning single stock options makes sense. I mean, there's a few, like, okay, I work at Morgan Stanley, and they're hitting me with they're giving me stock, and I could buy some out of the money puts. But in general, you can't even do that. That might be a good use case, because you have too much Morgan Stanley stock because you're working there. But generally, Morgan Stanley will say, no, you can't buy puts on our stock. So it's not even, that use case doesn't even exist. But so there's just all these crazy things going on out there. Look at MicroStrategies, this company that owns Bitcoin and is trading, 2 times or more than in value than the underlying Bitcoin that it owns. The volatility is huge. And then you can buy an ETF that gives you 2 times leveraged exposure to that. So there's so many things that my mom could be doing that she's not doing, that I'm happy about that. But I wish that we could, get people to just really think about these things more carefully than they are, and really think about the risk, because it's the return part. Sure, investing in markets, you have a positive expected return. But this you've got to take account of the risk, because the risk, as we started in our conversation, when risk is high, it eats the return that you want to use for eating.
Exactly, it's nicely put. You mention Bitcoin there, and clearly Bitcoin has risen sharply in value since Donald Trump won the presidential election. Maybe I've been a bit puritanical about cryptocurrencies in the past, and urging people not to invest. But, if people want to invest some of their money, then, I don't necessarily see that as a big problem. But can you spell out how much risk people are actually taking by investing in, if that is the right word to use, investing in Bitcoin and cryptocurrencies?
Well, I think the question is connected to how much of one's savings one puts into Bitcoin. So because the risk that you're taking is proportional to how much that you put into it. So if you take 2 or 3% of your wealth and you put it in Bitcoin, then no matter what, that's going to be even if it goes to zero, that's a relatively small risk on your overall wealth that you're taking. But, Bitcoin has historically moved around by, on average, 4 or 5% a day. So it's had what we would call 60% annual standard deviation of returns. There's lots of years where it's gone up or down by more than 50%, sometimes a lot more than that. So it's very, very risky. And the question is, what is the expected return of Bitcoin? And if we were going to create a course in financial literacy, and I'm quoting a little bit from one of our favorite financial journalists, Matt Levine at Bloomberg, where he says that maybe the first question, and maybe the only question that we need, people to think about in teaching financial literacy, is if somebody comes to you and says, "I've got this investment, it's got a 20% return and virtually no risk," that you should realize that that's not possible, that somebody is trying to pull the wool over your eyes. And as soon as you get that, that there's just some amount of return relative to risk, that markets, no matter how imperfectly efficient markets are, we're not saying that markets are perfectly efficient, but just a modicum of market efficiency, means that we can't go out and find things that have, super high expected returns relative to the risk. So given how risky Bitcoin is, I think that, sure, if you're bullish on Bitcoin, I think that believing that it has a 10% annual expected return is reasonable. It's in the vicinity of what you would get for investing in risky single stocks on average. And so that gives you some idea of, if that's the case, you could kind of come up with how much of Bitcoin makes sense for me to hold. You would have to think about how it correlates to other things in your portfolio. Probably the most aggressive assumption you could come up with is to say, oh, actually it doesn't correlate with anything. It's perfectly uncorrelated. That's not how it's been behaving. It's been behaving that it goes up when stocks go up and goes down when stocks go down, but we could say it's uncorrelated. And that would lead us to some amount of Bitcoin, that would make sense for somebody to own, given that sort of expected return. But if somebody says, I think Bitcoin has a 60% annual expected return, I think that's just out of the question as a reasonable kind of estimate for somebody to have.
We're touching here on a key theme in your book, which is position sizing. There is inevitably a lot of debate in the media and in the pub about what to invest in, but it's actually all down, you would say, and your colleague and co-author James White would say, to how much you actually allocate to that particular security or asset. You were saying invested 80% of your own money in LTCM. So how do you work out how much to invest in a particular asset?
Well, I think that the framework that I really like is to try to start off by breaking the world into just two assets, a safe asset and a risky asset. And this risky asset can be, whatever I think are the best combination of risky things. So I want to try to break my decision down into these two parts. One of them is, what are the risky things that I want to invest in, and trying to build some combination of those risky things that I think is good. For me, my risky things are just the global market cap index fund, So I have one simple thing that I pretty much, more or less, that's my risky thing. But other people could say, well, I like this or I like that, and they say, okay, I'm going to put them. And then your second question is, how much of the risky thing do you want to own? So both of those decisions are really important. The selection decision, what are the risky assets and what combination of them do I want? That's my selection question. And then the sizing question, how much of that risky portfolio do I want to have? And then how much to keep in safe assets? And if I want more than 100% of my wealth in the risky stuff, then I have to be leveraged and borrow money over here. And that's the paradigm that was given to us in the late 1950s with the capital asset pricing model, and all these Nobel Prizes went out to these guys that really helped us to think about the problem in this simple way. Now, these two decisions, selection and sizing, that's really what all of our investing is about. And it's interesting, I think that they're both important. You have to get them both right to be successful in the long term. But they're different in the sense that if you get the selection question right, you buy good things, but you get the sizing one wrong and you own too much of them, or you don't own enough of them, that's kind of catastrophic in the long run, especially when you own too much of them. You can go bust. Even though you own good things, you can go bust. So the sizing question is kind of paramount to get right. Even if you choose poor investments that do poorly, if you size them correctly, you survive and you can smarten up for the next round of your investing. The other thing is that the selection question is competitive. Everybody's trying to figure that out. Everybody's trying to figure out what are the good things, and you're right only to the extent that other people are kind of wrong. Unless you go for a simple indexing approach that everybody can do. So this is competitive. The selection decision is really competitive. You're fighting against everybody to get it right. The sizing decision is simple and it's not competitive. Everybody can size their risk the way that's good for them. And your gain from sizing things correctly is not someone else's loss. So it's not zero sum on the sizing. Sizing is easier as long as you realize that you need to answer that question.
You say the sizing question is simple, but actually there are a number of moving parts there. There's, can you afford to take the risk? Do you need to take the risk? And also that really difficult issue of, how comfortable are you with market volatility? How comfortable would you be if your portfolio went down, 30%, 40% in one go? Those are actually quite tricky questions, I would say, to answer.
They can be. I think they can be tricky questions. I think that when you spend more time thinking about them, they start to, open up as simpler things. So One of the ways that we like to help people to think about it is to say, thinking about investments like stocks brings so many different moving parts into the conversation. Let's just imagine that you're flipping a coin, and the coin has a positive edge that you expect to make money with your coin flips, but it's a very easy risk to understand. So you could say, I'm going to flip a coin. If it comes up heads, I make a 20% return. If it comes up tails, I lose 10% of my wealth. And then ask yourself, like, how do I think about that one? Do I like that? Would I be happy taking that risk? Would I not? And you could come up with 4 or 5 different coin flip questions to ask yourself, which would help you to triangulate and really figure out how risk averse you are, and then apply that to your investment portfolio, then moving away from coins, which are kind of silly, and into actual, stocks and safer government bonds. So we like doing it like that. I mean, another way that you can do it is to also just look around and see how other people have calibrated their risk aversion. So, in our book, we talk about surveys that we've done and where we found that most people were kind of in a range of risk aversion that was pretty narrow and pretty sensible, and also ties in nicely to the questions, around these kind of coin flip thought experiments. So, I think when you just go right at it, when you go straight directly at it, it becomes a little simpler. When I think a lot of the questions that we ask ourselves, the softer questions that we ask ourselves around it, like, how am I going to feel if I lost 30%? Well, we're going to feel really bad. We know that, but it's not as it's helpful, but it's really helpful when you start to put the risk against the return and try to think them through in the simplest way, even though that's a little bit unrealistic. Nobody's giving us a coin to flip, but investing in the stock market is a little bit like flipping a biased coin. But it's just easier to think about, the coin flip, and you can even simulate it and play around with it. Ultimately, it might just be that you go for a really simple kind of approach of, what? I'm going to just blend everything together, and I'm just going to try to keep 60% in stocks for the next 10 years, and I'll reevaluate how much I want in stocks 10 years from now.
This has been a really interesting discussion. You've come up with some very helpful insights. Just to draw it to a close now, can you just summarize what you would say would be good advice to investors? I suppose I'm particularly thinking about young investors, tempted to trade individual stocks and so on. And of course, not so young investors like your mum at 90. What would you say to those people?
Well, I think that making good financial decisions is like this low-hanging fruit that we all have to avail ourselves of. It's not difficult once we realize how important and consequential these decisions can be for our lives. So on the investing front, those decisions, I think, and a lot of other commentators feel like the investing decisions are relatively straightforward to get relatively right. So you're a young person, you're getting going. A lot of people feel that, think about it as, you've got your human capital. That's probably the biggest part of your total wealth is your human capital, what you're going to earn, and some of it to save in the future. And so with your financial capital, it's kind of okay to own a little bit more equities than otherwise. It's probably okay to be almost 100% in equities or 90% in equities. And to own those equities through a low-cost global market cap index fund, own the 15,000 companies that are out there. You can own all of them at no extra cost versus owning 10 of them. Own all of them, because you never know which are the ones that are going to be the next NVIDIA or the next Apple or whatever. I mean, that's only 4% of all U.S. stocks have represented all of the gain of the U.S. stock market. That's a recent piece of research from a professor in Arizona. Right. So we know that diversification has this extra thing of like, geez, it's just a small number of, you've got to make sure you get that you own those small number of stocks that are stellar. And the way to do that is by owning everything. As Bogle said, don't look for the needle in the haystack, just buy the haystack. And so I think on the investing front, own market cap index funds. If you're young, maybe be close to 100% and do that and just keep putting your money into that. Take advantage of whatever tax advantage savings programs there are. As you're getting older, and your financial capital is getting to be big and your human capital is getting to be a smaller component of your total, maybe you start moving towards being 70% in equities. It kind of depends on the environment also. It depends on whether equities are offering a good return relative to safe assets. And there's lots of places to go and find what observers believe is the expected return of equities relative to safe assets. And then, so try to do all of that in a simple way that's not taking a lot of your bandwidth, and then really devote your bandwidth to, first of all, doing the best choice of career and performance in your career as possible. And then also, really be sensible about all these other big financial decisions that we have around us too. Investing is one, it's important, but we have to get all the other ones. It's so valuable to get all the other ones right too. What are we doing, with insurance products, and what are we doing with our choices on education? What are we studying? Where are we going to university? If we are we doing a trade and technical path, a vocational path? What are we doing about housing? That I think people really do poorly by viewing a house as a wealth-generating investment. No, it's where you live. Focus on it being where you live. It's not a wealth generator, but you might want to prepay all of your rental payments in the future by buying a house. I'm not saying don't buy a house, but don't view it as I'm going to buy a house that's more than I need because it's a good investment, or I'm going to buy a house and I'll buy another house around the corner and rent it out. No, get that diversification of the stock market. And there's, a bunch of these financial decisions are out there. Don't buy lottery tickets, don't spend a lot of time, sports betting, enjoy supporting your football team and,
Very
don't start, betting, in-game betting and all of that. There should be a big sign that says, we only let people gamble on our website if they lose money. If you make money, we will kick you off our website, and it is illegal to stake somebody else with your betting. They should say that somewhere so that we know that it is absolutely a mug's game. So I think, get the investing right and get your spending, in line with your income and investing as well. So lots of things that we can do to improve our financial well-being, and they're all really simple.
Final question. You end your book with a quotation from the comedian Milton Berle. Money can't buy you happiness, but it helps you look for it in more places. What have the highs and lows of your career taught you about money and happiness?
I think that my investing decisions over time have really led to the book. That the mistakes that I've made, the mistakes that I've witnessed others make as well, has really helped me to a point where I feel that there are simple ideas to share around risk and trying to maximize our expected risk-adjusted wealth, our expected welfare, that really can help people to make better financial decisions and avoid many of the mistakes that I made myself. At the same time, at my age, as I'm getting older, I'm just absolutely aware that money is not everything. That health and love and companionship and all of these things are incredibly important, and you can be fabulously rich and incredibly unhappy, and you can be not very wealthy at all and incredibly content. So, but more money is better than less money. I think that's a pretty general rule. There's a decreasing marginal benefit that we get from more and more money. So those ideas could really live together for me at the same time comfortably. And I just kind of want to have a simple approach to money where money is not like something that I'm thinking about all the time. I mean, financial independence means that you're not constantly monitoring and managing your money and trying to get more money. Just a sensible approach, which our society has come to this magical point where we can all avail ourselves of the very best in investing, and all we have to do is ask for it and not be led astray by promises of get rich quick schemes and so on. And we're just in this wonderful place where people should be availing themselves of this terrific set of opportunities to invest, diversified, low cost, transparency, and it's just a question of staying on that path and believing in that path. You have to believe that that's the right place to be, and then stay there.
Victor Hagani, thank you so much for your time and your wisdom, and for talking with such candor about your career and things that have gone well and things that have gone so well. We really appreciate it.
Thank you, Robin. Pleasure. Yeah.
You've been watching our interview with financial author and educator and investment manager Victor Hagani. We'd love to receive your comments on what he had to say. And if you enjoyed the episode, please subscribe to the YouTube channel. We provide regular, high-quality video content on a wide range of investing-related topics. Thank you to Timeline for supporting the Investing Show, and to you, our viewers and listeners. Until next time, goodbye.